The Dunning Africa Center. It's not a place, it's a continent-wide conversation. This June, we're asking why Indian firms in Africa are so much less visible than Chinese investors. Our distinguished panelists, hosted by Prof. Rajneesh Narula, are drawn from across the world and work in business, academia, and government. Join us as we ask the pressing questions facing African business today.
Oh, excellent. Welcome everyone to the June webinar from the Dunning Africa Center. Once again, we're here to entertain you and to enlighten you simultaneously. It's a interesting challenge that we present to ourselves, and then of course to our rather engaged audience. We come up with questions which I think that are on the minds of people in general, and we hope that by bringing a bunch of experts from different areas, from different locations, we can actually kind of develop a number of ideas and come to an understanding about things that might not necessarily be transparent. So we're dealing with opacity and shedding light, hopefully, not in an evangelical way, but in an intellectual sort of way. So thank you all for joining us today. Today, the topic of we're going to engage with is Indian firms in Africa. Why are they so much less visible than Chinese investors? And this is kind of an interesting conversation, of course, that kind of puzzles me and puzzles many people that I have talked with over the years. That China has sprung from behind, so to speak, and become much more visible in many ways. In fact, in some cases, more visible than traditional colonial investors like the United Kingdom and France and so on. But on the other hand, we see Indian firms have been in Africa for a very long time. And as fact, one of the conversations we're going to have is, I thought that they just came weeks after the Europeans arrived in Africa. But it turns out that they came before the Europeans arrived, at least apart from Mango Park, who might have been here a bit earlier than everybody else. But anyway, that's the conversation we're going to have. Let me turn and introduce you to our wonderful team today, in no particular order, okay? Just so that no one should take offense that they're not following an alphabetical or counting gray hairs and so forth. I don't have any to compete with, so I don't want to get into this conversation. So we have Terry Wire, and Terry is an investor and an advisor, and he's managing director of ESI Capital, and he's based most of the time out of South Africa, if I'm not mistaken. And he's been across the continent. He advises global investors, development institutions, fund managers on how to design and scale blended financial vehicles that combine commercial and concessional capital. So, really a broad-based thinker, integrating catalytic tools such as first loss structures, guarantees, technical assistance. So, he has been he has an old hand on the continent. And then we have Ramesh Buchikal, who is an old friend, and I should mention on a personal scale, his wife and I went to ABU together. So those of you in the room who are ABU graduates, he's sort of one of ours. He's also an old Africa hand. He's currently the CEO of Africa Improved Foods, based in Kigali. Previously, he spent almost 30 years, I think, in Nigeria, or maybe more. And he was CEO of Tropical General Investments, Agribusiness, and president of Olam International. And those of you from Nigeria in the room will, of course, know Olam. He has widely traveled. In fact, he's the most traveled person I know. He's personally responsible for a big hole in the ozone layer. But he knows everything there is to know about the subject. So as a practitioner, turning to Roger, Dr. Roger Fon is a colleague of mine in the UK academic, and he's assistant professor at Newcastle Business School. I've known him since he was at London School of Economics, where he still has a position. He's a specialist on looking at the strategic motivations of foreign investment in Africa, and done quite a lot of work on Chinese FDI in Africa. So, we are in good hands in his case. And last but absolutely not least is Dr. Biswajit Nag, who is professor of trade, I believe, at the Indian Institute of Foreign Trade, which, by the way, is a partner. You may see an extra logo. I think I'm pointing at the right place. It's hard to tell from the camera. IIFT. So we have a joint venture. Today's seminar is a joint venture with IIFT. And he has been involved in empirical economic research in issues of trade, global value chains, and so forth for at least 25 years, even though he looks younger than the rest of us. But there you go. Yeah, so I think he has been an advisor to Indian government, to various international agencies, and I think UN SCAP and so forth. So yeah, we will hear more from him. Now let's get to the action, the story here. And please, people, the chat function is on. Feel free to comment, add anything you like. We will be happy to take questions. We'll start off with me probing these individuals about what they know. And if you have questions, you want me to direct the conversation in a particular way, I'm happy to do so. So please, people, feed your comments into the chat function, and yeah, we'll come to you. So let me start off with the first question. Is really, let's put a sense of the number. What are we talking about? We're looking at FDI in Africa. What do the official statistics tell us about, in general, about FDI in Africa, multinationals in Africa, let me say, and then of course within that Indian FDI. Roger.
Thank you very much, Rajneesh. Hello, everybody. So, I mean, historically, if we look at foreign direct investment into Africa, what we saw just after the majority of African countries gained independence was lots of investments from the so-called traditional partners, so-called former colonizers of African countries, France, the UK, and also lots of investments from the USA as well, going right up to the 1990s, early 1990s. And from the early 1990s onwards, what we observed was a gradual and persistent increase in FDI from emerging markets, right? Particularly Chinese multinationals starting to invest a lot into Africa around the mid to late 1990s. Particularly firms that are mostly state-owned. But Indian multinationals only started to really increase their numbers of investments around the 2010s. We started seeing a lot of investment from India catching up with Chinese multinationals or Chinese investments in Africa. I've looked at data on FDI whereby multinationals build their subsidiaries from scratch. So greenfield, so-called greenfield FDI from FDI markets, which is a specialist branch of the Financial Times newspaper. And what the data actually shows right now, as we speak, is data from 2003, so early 2000s to 2019, for example. We see that the number of investments carried out by Chinese multinationals and Indian multinationals is not too dissimilar. The sheer number of projects, the FDI projects, is not too far away from each other. Where we find a huge discrepancy is in the level of capital expenditure. So how much investments that each type of investor invests into Africa, with the Chinese investing much more. The average Chinese investor between that period, for example, 2003, 2019, invest just over $250 million compared to about $80 million for the average Indian investor. So a huge discrepancy in terms of capital expenditure. Now, when we look at the sector, which I think is very important, what we find is that the Chinese are heavily concentrated in extraction and also in construction. So those two sectors are very, very important for the Chinese investments into Africa. Now, with the Indian group of investors, what we find is their investments are a little bit more spread out. So we get some manufacturing, We get some ICT and internet infrastructure investments, logistics and distribution, for example. So from a sector point of view, we can see that there's a discrepancy there. And that kind of explains why there's a discrepancy as well in the capital expenditure, because extraction and construction are hugely, of course, much more capital intensive. Now, when we look at the destination countries, for Chinese investors, they tend to, it almost mirrors the sector. They tend to go to countries like Niger, Sudan, countries that have got some huge natural resource endowments, or the minerals, or oil, for example, in terms of capital expenditure. With Indian investors, there is some evidence. I think we're going to talk about this a little bit more as the webinar progresses. There is some evidence that Indian investors go much more to so-called Commonwealth countries, so countries that are part of the Commonwealth. There is some evidence. So you see a lot of investments in South Africa, for example, Kenya, Tanzania, places like that. Maybe there's some link with diaspora investments as well there, but we're going to unpack that. So that's just, I hope that gives a bit of a holistic view of what's actually going on between these two key investors.
Thank you. Thank you. This is exactly what we wanted to get a kind of sense of. Now, before we go further, I realize that not everybody here is familiar with the jargon, and maybe we should clarify what we mean by FDI. And so FDI means foreign direct investment. And the key word for the audience, those of you not in this area, is the word direct. Direct investment is different from portfolio investment. Portfolio investment, you make the investment with the intention of getting a passive return. You're not engaging in controlling the activities of the operation in that country. You're just buying shares or so forth. Whereas when you have a direct investment, you are engaging with active control of the operation. At least that's what the official terminology is. When it comes to statistics, and I think maybe, one should also come to understanding that there's stocks and flows. Maybe Biswajit can just help me a little bit with explaining in layman's terms difference between stocks and flows.
Yeah, it's a very common jargon in the literature of investment. Thank you, Rajesh, and welcome to everyone. So stock here is basically the total amount of investment which is there in the country. And flow is basically coming and how much investment is coming every year. Now, interesting thing here is whenever any country commits for any investment, the investment may not come at one go, right? So it may come in stages. Suppose any country wants to build up a factory, so they commit for some amount of money, but it will come slowly. So every year it basically comes as a flow, but at the end of the day, it comes as a total stock. So both stock and investment data are important because you need to understand what is the total amount of control by the foreign companies and how much is coming from which country every year. So that's the way basically the literature actually highlights the investment data.
So the point, of course, is that in the case of stock includes reinvested earnings and local investments as well, or money that you borrow on the local markets, and not just the money that is coming from abroad. So there's a tendency for politicians to obsess about the flow data, which is the new money coming from abroad, as opposed to the reinvested earnings and the local capital that might be generated. So if one wants to understand the impact of the investment in terms of employment opportunities and so forth, it makes more sense to use the stock data because it tells you what has happened cumulatively over time. So unfortunately, politicians pick the flow number and run with it, in part because the statistical agencies collecting it are stuck in the 1950s. But that's another story. I'll criticize the data collection later on. But let me turn to Roger. One of the discussion here that becoming more important is the role of global value chains and non-equity. And the fact that this is actually something where we don't see equity investment, we don't see FDI flows per se, but that firms can actually have control over an operation in the absence of FDI. Foreign firms can. Maybe you can say a little bit about that, Roger.
Yeah, I mean, the idea of global value chains, just to clearly define what we're actually really talking about. Global value chains is simply the range of activities that that multinationals carry out, usually over multiple countries, that lead to the production or a particular end product that delivers the product to the consumer. And the global value chains describes how value is added in each stage of the production process. In Africa, like most developing countries, what we see is that most developing countries, as there's too much reliance on the primary sectors, so the oil sector, or the cocoa sector, or the mining or the mineral sector, and the goal is always to make sure that to get some kind of sustainable to develop economically, you need to add value. That is to say, you need to be able to transform the raw materials or primary the raw materials into creative assets, into transform manufactured goods. So that is one way of gaining development in most developing countries. That is the goal, particularly in Africa. Now, there is a debate on whether African firms benefit in terms of linking up with multinationals that invest in the African continent. To what extent do they actually benefit from the presence of multinationals from developed economies, or in our case today, from emerging markets, investing Chinese investors, African Indian investors? Do they really benefit? Yeah. Are there some form of linkages happening, and that creates spillover effects?
We'll come back to the impact thing in a short while. What I want. So now I'm sorry to the audience that we're being technical, because I want to get the terminology right before we get into the story. And when we talk about GVCs, also, and we'll talk about FDI and the absence of FDI or the lack thereof, we also have to speak about the technical challenges of trying to understand actually where's the money coming from. Is it really Indian FDI? Is it really Chinese FDI? Is it really American FDI? Because we have this phenomenon known as tax havens and round tripping. So in fact, one of the kind of questions that comes up is a lot of investors are not necessarily going to label themselves as Indian investors. They are registered as a British company or a case of, and I think Biswajit, maybe you can tell us a little bit about this, the phenomena of tax havens, the case of Mauritius, for instance, which is that becomes a source country for a lot of FDI.
Yes. So what happens in most of the countries, the FDI enjoys some benefits, especially in terms of tax or any other benefits in terms of priorities. So sometimes what happens, the domestic money, which generally gets invested, do not enjoy that. So there is a possibility of round tripping. So for that matter, Indian money can go out as investment, and from there it goes to a third country, and from there it comes back. So it doesn't remain as an Indian money anymore. So, so some of the countries provide tax havens. So Mauritius is one of the countries. So if you look at India's FDI data, so you'll find that maximum number of investment is coming from Mauritius. But everybody knows that Mauritius cannot invest so much in India. So it must be somebody else's money, right? So, and large part of Indian investment, Indian companies are actually round tripping this investment and coming. So this is also common in many other parts of the world. Even in China also, the Hong Kong is the place where actually the round tripping happens. And this inflates the FDI data. As Professor Narula has mentioned in the beginning, So from the official FDI data, we do not able to understand that, how much is real investment coming from other country, or what is the domestic investments actually coming back from other countries. So that's basically the concept of tax haven and round tripping. But now actually we can link it to many other aspects of that. Sometimes what happens when Indian companies, even their export earning, or as well as their investment earning in other countries, for example, Indian investment in Britain, so that investment profits may not get repatriated to India, right? So
Yeah.
it gets, it goes to some other country, and from there it comes. So it is not really a round tripping also. So it gets mixed up because some of the foreign earnings also being invested through the same mode. All right. Yeah, that's all.
Absolutely. No, thank you. That's very useful. And I think this is sort of makes it the water a bit more muddy. That is, when we look at this type of investment, we're looking at the passport of the investor or the bank or the investment organization that underlies the investment, and where is the money coming from, and where is it going to, who is getting the benefit of it. So one would actually see this quite a lot, is that about 50 years ago, 70 years ago, you would see the investment not coming necessarily from India but through another destination, often for tax reasons, but also the diaspora. And should mention that there are generations of business of Indian diaspora living in other countries. One of the largest recent investors in Nigeria has been a Indian family that's based out of Indonesia, if I'm not mistaken. But let me turn to the actual person who does the investing, Ramesh. Maybe we start off with telling us a little bit about the historical note. I know you are almost a part of history now, and tell us a little bit about the facts as you know them.
Right. Thank you, Raj. Um, I'd like to start by suggesting that the Indian entrepreneurial spirit is deep and very brave. So, for example, some of you may be aware of one of the oldest families in business in West Africa are the Chanrais. The Chanrais came to Sierra Leone in 1860. So we are talking of 160 years of hardcore presence, seventh, eighth generation of leadership, now still present and still going very strong. I must tell you a short story here, Raj. In the early 30, 40 years of their existence in Sierra Leone, they were transmitting profits every quarter on camelback across the Sahara to Port Said, catching a boat from there to go to Sindh to distribute the profits to the families. We are talking of that kind of entrepreneurship. The Chinese enterprises, in my view, are significantly newer when China became brave and strong and rich. And all of us who've been in business in Africa have begun to see the Chinese also significantly lately, like 20, 25 years back at latest. Now, there are two kinds of Chinese entries. One is the really small guys who want to remain undercover and do a lot of illegal things. Okay, timber exports, gold exports, mining exports. Go to Ghana, go to the Ashanti sector, and you'll see the number of Chinese investors there doing all kinds of things. Okay, completely undercover, no registration anywhere. Liberia's timber export is full of the Chinese. All of this, of course, is not above board and legal. Then there is the Chinese intervention that I have seen when I was in South Africa, wherein they came in and bought up 20% of Standard Bank, and they did those kind of things. In my understanding, approximately 6,000 kilometers of roads, 6,000 kilometers of railways, very visible, big bang, large scale investments. Therefore, one sees the Chinese a lot more than one sees a lot of the Indian entrepreneurs who've been around for hundreds of years. Also, there's one other difference, I think, Raj, is that Indians by nature like to stay undercover. I suspect it's their way of hiding from the tax authorities. While the Chinese, especially the SOEs, like to make a big noise about it, largely because they want to make a point that they're contributing to the continent. There was a trip that Xi Jinping made, I think 2011, 2012, and he distributed about $50 billion in grants to 5 African governments. And in the bargain, got back either petroleum deals or construction deals or highway deals or airport deals, right? So what they've done as SOEs is really big bang in the face and very visible. Therefore, we tend to talk about the Chinese, while the Indians come and do really small stuff and therefore are undercover and invisible. Having said that, I must say that across Africa, especially in the Commonwealth, like Roger said earlier, I suspect largely because of the language comfort, Indian businesses have been around for a very, very long time. One more last point, Raj, is that in West Africa, there are two large business communities, the Lebanese and the Indians. As usual, the Lebanese take the big risks, really skirt the border of what is right and what is not right by the law. But the Indians do really small stuff. They beat the VAT and they beat the taxes and they beat the import duties and really small stuff. But the Lebanese do the really big ones. So yeah, so that's my take of the history of these three business communities.
Now that's really interesting. I mean, yeah, I mean, it always struck me when I was growing up in Nigeria that I would meet these Lebanese. We call them Syrians. It was a generic term in those days. The Syrians would have no. There were some people who were in their 70s and they had been born in Nigeria, and kind of they don't know anywhere else from than Nigeria. So this is sort of a common feature, of course, that I myself also have that sort of background. So, but in terms of dealing with kind of you point that the Lebanese, the Syrians do things differently from the Indians. Terry, you deal with lots of investors of different types. What's your perspective on this? How different are the Indians from not just Chinese, but from the European investors, American investors? How do you perceive a difference when you're managing them or you're working with them?
Yeah, thank you, Professor. Yeah, I would echo my colleagues that are on the panel here in terms of the Indians versus the Chinese and how they go about investing. And it comes down to policy, to be quite honest. So the Chinese have a policy that they put in place in 2013 called the Belt and Road Initiative. And so that is a major policy at government level to do infrastructure investments, not only in Africa, but globally. They have made a big splash in Africa, as we all know, whether it's roads in Kenya or a bank in South Africa. They've made quite a bit of loud noise in terms of investment on the continent. Whereas, and again, I'm echoing my colleagues here, the Indians tend to be more private sector led and family driven, highly risk sensitive as well. So they tend to not really try to make a big splash, whether that's for tax reasons or what have you, but they tend to, and from my own experience of working across, let's call it East Africa, they have big exposures, but it's really at a family-owned kind of and private sector led. So they don't come in with SOE money. They come in with family money. They buy up agriculture. In the case of Malawi, for example, there are banks that are Indian-owned in Tanzania, in Kenya. And as we talked about earlier, I think that they use places like Mauritius to bring that capital through. So it's really not, again, the big exposure that the Chinese get when they come in and do these big, large infrastructure projects. So I think, generally, and over the last short 4 months, since the new U.S. administration has taken over, we've seen dramatic shifts in the type of money that's flowing into Africa. So we're moving away from the Americans started it, but the Europeans are also moving in this direction in terms of moving away from foreign development aid and working more towards trade and investment initiatives on the continent. And so we're starting to see the Americans, and I mentioned it earlier in a call, the Americans are tripling their budget for their state-owned investment arm, which is to come in and really focus on more of a Chinese approach. I wouldn't say it's going to be exactly like the Chinese, but it'll be more of a transactional approach rather than soft power, which development aid brought into the equation. And the Europeans are going in that same direction now. So they're reducing foreign development aid and looking more towards investments onto the continent. But going back to the original point, I think that Indian investors are typically more cautious. They're more entrepreneurial. and relationship driven, whereas the Chinese, especially via SOEs, are fast, state directed, and strategic, and they like to come in with large projects. So I'll stop there. I'm happy to answer any other questions, though.
Oh, that's very interesting. Thank you, Terry. I mean, we're kind of. I want to go a little bit beyond the Chinese comparison because in the end of the day, you know, everyone talks about the role of FDI, of investment, as a driving economic growth and driving economic development. And this is something I've spent most of my career trying to write about, uh, is how much and why and how does it matter. And of course, we don't see as much growth, that is the FDI driven kind of growth that we would like to see, that we've seen in East Asia and so forth. And you know, there are reasons for that, and I think we will dwell into this. But what I want to come and talk about is the commodity, the issue, because most of the FDI that we see tends to be attracted, as Roger has pointed out, and Biswajit as well, that it's directed towards extractive, well, resource-intensive activities. You know, commodities, or whether they are mining or agriculture, and that's where I think Ramesh's expertise as an investor is strongest in our 30 years of doing so. And you know, it's fascinating. I mean, I've been to I've seen some of his operations when he was at Olam, and they're quite impressive. But of course, the thing is that in terms of the development effect is fairly minor, because the grains or the, you know, the produce bought by the factories, but isn't necessarily processed over there. It's processed elsewhere, and that's, I think, the, you know, the where the benefits, so to speak, the spillovers, the linkages come from. Uh, so is there any difference, and I turn to both Roger and Biswajit on this, is there any huge, is there a considerable difference in terms, do Chinese companies have greater linkages when engaging in primary sector activities than the Indian firms? Is there a difference? Is there some greater benefit? Let's start with the academic perspective, and I'll come to Ramesh.
I think it's a bit of a complicated question. There was a study that was done just a few years ago, looking at Chinese and Indian investors and the amount of linkages that these investors actually linkages that happen in the context of Zambia. Zambia was the host country at the time, and there wasn't actually. It was difficult to find any evidence of deep linkages in Zambia. So, for example, what they found is the Chinese, for example, preferred to bring in their own suppliers. The Indians were not so loyal with their suppliers, and were very price conscious. Right. So that's one thing. I think the other thing is that for linkages to occur, it is important that you have firms that are capable of linking up, right? So the question of whom to link with really matters. So in most African countries, unfortunately, what we find is, although this is improving a little bit, but what we find is a bit of a weak firm capacity. So firms that don't have the capacities to be really good, strong suppliers, right, to huge multinationals, for example, right? So even if multinationals are willing to embed locally, the question of whom to link with really matters, because you have to find suppliers that are capable. Now, with the Chinese investors, with these huge extraction investments, it's very capital intensive. To be a supplier at that level, you have to have very strong competitive advantages. So it becomes very difficult if the investments are in the extraction sector. There is some potential. I think there is potential for linkages, but as I said, weak firm capacity is a huge problem. The type of investment, so extraction versus manufacturing. So manufacturing investments are likely to produce better, deeper linkages than extraction investments, because extraction investments are usually, the Chinese usually have basically enclaves, usually enclaves that make it very, very difficult to embed locally.
Yes, thank you. Now this is throwing some light. Biswajit.
Yeah, I would like to answer this question at two levels. First, I'd like to talk a little bit about global value chain and how we can create or destroy jobs also. Um, so, global value chain is generally been studied from two angles: forward linkages and backward linkages. Generally considered the forward linkages good because you are exporting components, intermediate goods to other countries. So there is a possibility of skills, technology. But in case of Africa, it's a very unique case because the entire value chain, they are actually in terms of forward linkage because they are in the extraction industry, the multinationals who may be having a factory in Europe or China. So they are extracting minerals from here and then exporting it. So in such cases, actually, the kind of jobs the extraction industry can create will be much, much less as compared to manufacturing industry, as just Roger mentioned. So that is one of the very typical problem of FDI in extraction industry. However, if you look at from the other angle, if the FDI in other sector, for example, Indian FDI is coming in IT or in telecom, so in such cases, directly they are not creating jobs, but indirectly it enable the common people, middle class who are entrepreneurial or who have aspirations, they can actually create new opportunities for themselves. Indian investments are also there in trading. For example, Olam is a very big company which is involved in trading. So investment in trading, especially in transportations and commodities, creating warehousing, so that also indirectly can create jobs. So the linkage is basically for which sector we are talking about and what is the nature of investment actually we are talking about.
Yes, no, I think this is a good point. Now, I of course have been over the years been looking at this phenomena with great interest. When does it have the most impact in terms of creating linkages, in terms of, and in fact, one of the reasons I visited the Olam operation in Kaduna a few years, 5 years, 6 years ago, was precisely because of this. In fact, I see Salamatu Isa, who's came with me on that trip to the operation, and understanding how they engage with local actors, often in the absence, and not in this case, but often in the absence of any active government policy to encourage linkages. So what happens in many countries, there are active policies to promote linkages, greater local content, hiring more workers, etc. And in my limited experience, often these linkages happen organically over time, but as we can see, very often they happen more slowly, and with some people, with investments from certain countries. Now, I'm not entirely certain whether there's a big difference Chinese and Indians in this regard, or it's well, the differences between Western approaches and Eastern approaches to some extent, because these multinationals, the European multinationals, have been there for even longer, and they have more complex organizational structures, and they have policies about this, because whether it's because of colonial guilt or because they find it more efficient or whatever reason. And that's why I'm going to turn to Ramesh, because I think there's a difference. What do you think, Ramesh? This is anecdotal.
I'll stick to the processing of agricultural commodities.
Yeah.
There are a couple of features which I think we should all remember as a background. One, the Chinese involvement in agriculture in Africa is a very recent phenomenon, number one. Number two, don't forget, bulk of the Chinese, in fact, I would believe 95% plus of the Chinese who come to Africa are looking to take the goods back into China, nowhere else. Okay. The Indians don't care. Wherever there's a commercial need, Indians or any other agricultural process take it to whichever market is the most efficient. So bulk of Olam's shares, for example, Olam's processed goods go into European markets largely because the high value products like cocoa and coffee, when processed and taken back into evolved markets, makes the most market sense. Having said that, African inefficiencies on manufacturing stand out as a feature. So I'll give you two examples. Sesame seed. China is the largest consumer in the world, and we all know this. It's a very small value, small volume item. All the Chinese imports have to be raw because even minimal processing attracts significant duties. So it makes no sense to process any of that in Africa and take it to China. So bulk of the sesame seed that's grown in Africa, Ethiopia, Sudan, West Africa, all go into China, okay, and unprocessed. That's number one. Cocoa, on the other hand, as you know, that significant markets are in Europe. So a company like Olam has 3-4 large processing units for cocoa in Ghana, in Nigeria, in Ivory Coast, and the processed cocoa mass is taken to Spain for blending. Now, here is a challenge. African policy does not allow you to import cocoa beans into your country to process because all the chocolate that's manufactured anywhere in the world is a blend of a variety of origins of chocolates, of cocoa. So you cannot bring Ivorian cocoa into Ghana and process it there. You have to take it to a third location and blend it there to hand it over to the chocolate manufacturers because these are patented fact compositions. Okay. Now, and Olam doesn't care whether the factory has to be done in China or Europe or America. It will be done wherever it makes commercial sense. While the Chinese are focused on taking it back to the Chinese markets, therefore they are restricted to the amount of processing they can do in origin. Therefore, there are almost no processing mindset that the Chinese come into Africa with. Does that make sense?
Yeah, no, it makes a lot. I mean, that's very interesting. I didn't think of this before, and that was really quite interesting. Now, maybe I should, Terry. I mean, you're a man who kind of is everywhere, um, and you've been across the continent, and I mean, how are we going to get around this? How can we coordinate such activity? Is there any attempt to do so? Do you know whether something can be done? Do you have any experience that suggests how can be addressed or should be addressed?
Well, I do know that there's been efforts over the last, let's call it 15 to 20 years for the local content piece. And the Chinese have obviously not made an effort there. So, I mean, we've talked about this. I was in Liberia recently and the hotels in town were overflowing. So I got sent out to a Chinese hotel. It was built by the Chinese. The workers were Chinese. The restaurant was Chinese. The soap in the shower was Chinese. So they bring everything along and build and put things in. So there's really no local content. But when you go back to cocoa and cashew, for example, there should be opportunities. But again, there's tax regimes that you have to get around and so on. So I know that there are efforts being made for local production and value add so that Africans benefit from products rather than just shipping out raw goods into communities like Europe or China or what have you. So I don't think there's been a lot of success, to be quite honest, but there are efforts being made. And one of the things that I would say, if we go back to the original question around India, and I think it was asked in one of the questions as well in the chat, was around what are Indian policies in regards to investment. So the answer to that really is, and again, I'll lean on my colleagues here, but from my experience, again, the Chinese have state-owned policy banks. They have infrastructure. They have financial tools that the government gives them as well. The Belt and Road Initiative and policy banks and so on and so forth. I don't believe the Indians have, a concerted policy effort that allows them to build the tools and methods that allow for either the private sector or state-owned enterprises to come into Africa more effectively. So I think that's one of the things that I would love to hear more about from the colleagues about how we can address or even make a recommendation towards the Indian government on how they can increase initiatives around foreign direct investment, or whether that's private sector or government. But so yeah, I mean, the answer to your original question, Professor, is that there's efforts being made, but I don't see a lot of traction, to be quite honest.
Yeah. So I mean, some of this we could be because we have terrible infrastructure, and even if we wanted to move, cocoa beans from Ghana to Nigeria or vice versa, I mean, and this I think is perhaps a part of the problem. I'm suggesting this. That even though there are efforts to create, there is a highway now between Ghana and Nigeria, but traversing this highway is another story entirely. And moving goods systematically from one place to another, I think that as Dangote is finding out, also trying to move his refined petrol from his refinery to other parts of the continent, maybe in part government restrictions, but in part also infrastructural problems. Ramesh, you will know more about this type of thing. What are the challenges there in infrastructure, state support, yeah, regulations, bureaucracy?
I think infrastructure is a far bigger challenge than bureaucracy because you can find a way around the bureaucracy. But complete lack of infrastructure is a huge challenge. I'll give you a simple example. We have this processing plant in Rwanda, which is it is profitable, but it's not meant for profit. It's meant for impact. Getting food from here into Chad, and those of you who know the African geography know that we are not talking of mind-boggling distances. It's about 2,600 kilometers, if I remember right. And both sides, the receiver and us, are significantly well-established players trying to make this happen. And it can take 32 days, 35 days, 40 days, 42 days. By the time it reaches, the goods are damaged, broken, this, then the other. Okay, so it's a very small example of the kind of logistical challenges we are talking about. So when the AFCFTA was designed and cleared and all that stuff, in principle, these are all great things to have. Logistically, making it practical and making it work is a completely different challenge. I think for now, if we look at Africa as a variety of hubs which operate in small regional baskets, that is good enough to work for. If we can get that right, it's already a big win, is my view. Having said that, there are a couple of challenges around logistics which I must mention. One, warehousing space. Two, roads. Three, not enough railway tracks, which is probably the reason China and India are able to do such a great job in efficient logistics. Excellent railway tracks. Lastly, shipping lines. Not half, 80% of the international shipping lines don't call most of the African ports because the cargo size is not large enough, or the port doesn't have the depth to take a big ship. You know that Lekki is the only deep ocean port right now in all of Africa, which is really strange. So the logistics challenges are huge, and it will take a long time before we are able to correct that. So we should all be ready that this is going to call for a lot of patience.
So in short, it increases the cost for actors to do anything really. That we are. So and let me come to the African Continental Free Trade Area, which is I think Roger has a couple of thoughts on, I suspect. And I have been saying for a while on various forums that maybe regional integration is the first step towards a continental integration. We cannot manage ECOWAS and SADC and East African Community to talk to each other, given the cultural similarities. I think for the audience who are not from Africa, let me explain that actually the similarity between West Africa and East Africa is very superficial. We may be on the same continent, but the languages are completely unintelligible to each other. And culturally speaking, also there's a fundamental difference. So reading the signals from of one group against the other is really quite challenging. And I mean, I have several stories on this, but this is not the place. The point I'm trying to bring us to, and I want to come to Terry on this, is to what extent will this make any difference to improving things? Signing a continental free trade agreement, do you see this as something that will make a difference in terms of investments coming from India and from other countries?
Yeah, I think that question's for me. I do. Yeah, the free trade agreement is beneficial, but it's I would say at its infancy at this stage, and infrastructure, as was already indicated by Ramesh, is a major hindrance here on free trade. I mean, I can give you an example of I organized a trade conference in Zambia where we brought in, and it was agriculture focused on commodities, and we brought in the governments of Kenya, Zambia, Malawi, Tanzania, and we were, we had a conference set up where we could actually get there and sign trade deals between governments and between private sector organizations. But then, and we signed hundreds of millions of dollars of transactions. But then what we found is that you couldn't get that grain across the border, literally from Zambia to Kenya or vice versa. So none of those deals, or very few of those deals, I should say, went forward because there was so much in the way of policy and lack of wanting to trade with neighbors that it really just hindered the ability to do this work. And I think that's still the case. Even though you've got the free trade agreement, you still have governments like in Malawi who say, well, the government, for example, gives away a bag of fertilizer to every person in Malawi. Well, not every person's a farmer. So, the story is that they sell that fertilizer down the road and so on and so forth. And then the government prohibits that other commodities coming in from Zambia or other places. So it really defines. So I think there's a lot of work to be done on the free trade agreement. It's in place, but it's in its infancy, and governments need to actually step up and agree to do this type of free trading. And I don't see that happening at this stage. And again, I'll lean on my colleagues who are experienced in this as well.
Yeah.
I think
I think this is. I think the Roger, you want to say something?
Yeah, no, I think the implementation has been a huge problem. If we compare what happened in the European Union, the creation of the EU, you had states that had initially reasonably good institutions coming together, bringing trade down, trade barriers and non-tariff barriers to increase trade. In Africa, we have a lot of countries that have got relatively weak institutions, putting together an agreement where barriers of free trade, tariff and non-tariff barriers have to come down, but the implementation, the enforcement mechanisms behind it is very, very weak. On paper, it says X amount of goods have to can leave Lagos and go into Douala in Cameroon and should enter Douala in Cameroon without no tariffs. So that is what it says on the book. But when it gets to Douala, that's not what really happens, right? There's a lot of difficulties. Well, but Cameroon is a signatory, and Nigeria is a signatory of the AFCFTA. So what should happen is the goods should enter tariff-free. But there is so much gridlock and problems, bureaucracies that is making it very, very difficult. So I think creating a better institutional environment is a prerequisite alongside infrastructure.
Yeah. I mean, getting qualified people to know. I've just been doing some work on the Busia border crossing and in East Africa, which they're trying to improve simplify the regulation, the STR going on, and it's not working. That is to say, they've tried to simplify the regulations, but the regulations are still complicated. Perhaps, and I ask this partly in jest, but also seriously, perhaps the complex bureaucracy is something the Indian firms are familiar with at home, because crossing borders in India, from what I understand, I know, is that there are state borders with state checks, and I remember the Economist once gave a amazingly big number for traveling. A truck traveling from Delhi to Calcutta has to pass through X number of checkpoints and so forth. Maybe this is something that makes it easier then, I hypothetically ask this question, to function in other countries where there are similar bureaucratic challenges. Biswajit.
I think, now the challenges of crossing the border, state borders in India has come down substantially because India has now adopted GST instead of, state taxes. So the taxation systems actually made it so simple. So now the truck can actually cross the border very easily. So that's one interesting thing. So free trade agreement, for that matter, is actually talking about the same thing.
Yeah.
But generally, what happens in my research and understanding in developing countries, what happened? Countries are relatively reluctant to reduce the customs duty. So sometimes they sign because it's a big visibility in the world of globalization. But while coming back home, when they calculate, they find it that customs duty is a significant part of the overall revenue. So one important thing is if we see the customs revenue as a percentage of total revenue is going down, so that means the customs revenue's importance in the total revenue is going down. So in that case, it is much easier for trade negotiator to convince the other country that look, so duty reduction is an important thing, and customs duty is no more important barrier. But what happens, octroi and many other non-tariff barriers are there at the border, right? So there could be a lot of such challenges. So we can study Central Asian countries because they are mostly landlocked. And there are a lot of research and discussions going on in this direction. So we can learn from them and how actually the border crossing actually can be made easier. I know some Indian companies who are in energy and steel productions. They are also trying to understand that far from to get the raw materials and then transporting it to another country for productions. And there may be a third country where is the market. So so there is a basically selfish interest of such multinationals who are operating across the border. So I think, we can actually put them in the driver's seat for negotiation with the government or in this particular kind of structure so that things become much, simpler. But I fully agree that in many of the African countries, especially the landlocked countries, crossing the border is a very, very challenging stuff, not only just because of the infrastructure, but the bureaucratic or maybe the traditional way of looking at barriers.
Ramesh.
Yeah. I think there is some evidence that perhaps the Chinese know how to navigate the institutional voids much better than the Indians do.
Which is actually a very interesting question because the Chinese don't have the same kind of voids. You would think that the Indians are used to bureaucracy. Indian bureaucracy is a global standard in terms of how complicated paperwork can be. So you would think that this was a comparative advantage of Indian companies compared to China, where, it's a state-owned company. So anyway, Ramesh, tell me, you're a man on the ground.
I have a point of view on this. I
Yeah.
think the Chinese are great at cracking governmental blockades. The Indians are great at unlocking interpersonal issues, on borders, on corners, customs, ports, all that stuff. The Indians are much better. One, because there's a language comfort. Two, because most of these Indians have been hanging around in this system and the Indian system long enough and have been trained in managing that. The Chinese get the backing of their government to unblock a lot of governmental issues, and that's where the Indian government can learn a lot. The number of Chinese investments that have come in, as we all spoke about, through governmental machinery, the Indians have not been able to do that. That's why the Indians are not here in a big scale.
Interesting.
Yeah.
Interesting.
I can add on to that. You can name this however you want to name it, but political sponsors or consulting fees or what have you. But the Chinese tend to have those government relations where they find a way to get it done. Let's put it that way. That's the nice political way to put it. But yeah, in terms of investment and deal making, there's a lot of signatures that take place in front of cameras, in front of media, that never take place because either the rules change in the middle of it, or you've just got barriers that can't be overcome in terms of trying to close on a transaction. So, I mean, there's many reasons for it, policy shifts, what have you, approval processes. But I've been party to many of signing ceremonies where a deal never actually came to fruition.
Yeah, this is
I
thank
think
you. This actually seems to be the question that Wilberforce has asked in the chat function. By the way, people, please, if you put questions in there, I'm trying to integrate them into our discussion. So feel free to put this in. Now, one of the Terry, while I have you on with the mic hot and everything, so how many? What? This is a very awkward question, but let me ask it. This is an academic forum. So when I went to Russia, so a number of years I went on a mission from the OECD to look at investment policies in Russia. And it's a long story in itself, but we tried to find out we tried to quantify the costs of setting up a firm in Russia. And we met all the people, and we realized that there were so many rules and regulations and levels of bureaucracy at various levels. It's still a socialist organization structure. And then we found out that we went to, I won't mention the name of the consulting company, one of the large, big consulting companies, and lovely offices. And I just come back from the official investment promotion agency, and they said the cost of registering a company, foreign company, and he gave us a number. It was a precise number, something like $5,000. That's all the money you have to give me, and then I will get all the papers and permits done for you. But it might take 2 years. And then we went to this consulting company, which starts with P and ends with C. And the chap says, the woman in charge says to me, 20%, whatever the value of your investment, you give us 20%, you sit back and we'll give you the paperwork. So it's precisely the cost of the bureaucracy was 20% of your investment. Whether you have $1 million or $5 million or $50,000, they give us 20%. We'll take care of the bureaucracy. Now, I always thought this is a lovely number to have, 20%. That's how much you need to pay. That's the cost of the bureaucracy. Now, I'm wondering sometimes I'm not sure Ramesh wants to give me a straight answer on this. What would you say is the equivalent cost? What would be the charge if you were to do it?
So that depends country to country. So the infamous countries in West Africa, the one with the largest population that I shall not name, the premium is way excess of 20%. There are other countries in West Africa which are significantly easier to manage, not just because the bureaucracy is a lot simpler to handle, also because the premiums are significantly lower. Francophone is a lot easier to manage in general. They follow bureaucracy, they follow a process, but the level of corruption is far lower. We can just look at the corruption index, and frankly, that's a very good reflection of what kind of premiums we must apply.
Okay. Terry, what's your thought on this? I know you have an opinion on this.
Well, I'll go back to your Russia story because I also lived in Russia and ran a business in Russia. So I had to maneuver through that bureaucracy. This was back in the late 90s. So yeah, you had to go to the top of your regional government or whoever it was if you wanted to get anything done. On a side note, I learned to drink a lot of vodka in that country because to get deals done. Or get loan payments back or what have you. So, yeah, I found, again, going back to Russia, that, going up through the government, similar to what the Chinese are doing here in Africa, going up the ranks of the government to get things done was the only way to get business done. If you tried to go through the normal channels, it was very, very difficult and a very long process. I mean, I can bring that back to a simple endeavor of trying to get a visa here in South Africa, which takes years to do. And so, but again, if you know the right channels, you can get it done. But if you go through the normal process, it's going to take you 2 to 3 years to get a visa in this country. So if we take that up to the trade and investment scenarios across the continent, again, I think Ramesh put it very nicely, and that it depends on the country, of course, but it's going to take a huge movement and government contacts and so on and so forth, trying to go through a normal channel is going to be extremely difficult unless you have your foreign government backing. So again, the Chinese benefit from that because they have foreign government backing. The US, to a certain extent, benefits from that as well, because sometimes when the US comes in, they can bring the embassy along to those transactions, to government meetings. I'm not sure how far that's going to go these days, but in the past that would work. So there's ways to skin the cat, as we say, but you've got to find the right way to do it. So, but it can be done. And then I'll point out to. I like the last comment here in the chat about let's get free trade between two countries before we try to do regional or a sub-Saharan Africa-wide trade agreement, because it's not working so far. So if we could get just even a regional trade agreement in place, which in theory we have, but again, they don't work.
Yeah, no, this is all a very good point.
Even previously, what we have in Africa called regional economic communities.
Yes.
So we still have the ECOWAS and the EAC, but most of these countries, there are countries that belong to about two or almost up to three different regional economic communities at the same time. There's all different rules pertaining to the EAC. For the DRC, for example, is part of the EAC. They're part of COMESA, and they're part of SADC as well at the same time, all in the same time. So this just adds to the complex. It just illustrates the level of complexity that we actually see. We see happening. Just on the point with the Chinese, all these costs are transaction costs that multinationals face when they invest in places that have got bad institutions. Now, the difference between the Chinese, or what is really, really unique about the Chinese, is the sheer, particularly in Africa, is the dominance of the SOEs, the sheer amount of SOEs that the Chinese have in the continent. And what this means is that these SOEs, of course, have got huge financial resources of the Chinese government. They are able to absorb all these transaction costs that perhaps private firms would struggle to do, right? So so the dominance of the SOEs, the diplomatic effect is absolutely paramount for the Chinese. They are able to absorb all these huge costs that normal firms, or for example, an Olam would really not want to, or it would be very, very difficult to absorb.
So in short, the point is the transaction costs being what they are, the profit margins have to be larger to compensate for that. And that's something that, from an economic point of view, is a loss to society, that people are making extraordinary profits to pay for the transaction costs. These are, and Biswajit, you probably have an opinion on this as the hardcore economist in the forum.
Yeah, it's a trade-off, actually. Because there is a large transaction cost, there has to be profitability. But I think the most important thing here, the Chinese investments are large. So large investment is having an economies of scale. So when there's a large investment, so large payoff and large profit, they all go together. And the problem of the Indian investment is basically the small investment. So every small guy needs to handle this kind of a complicated situation independently. And it's not possible for a democratic government like India to support in such activities, out there in Africa. So government of India can back up with a large investment when maybe an automobile company or maybe a big IT company moving there. So government to government, formal discussions and negotiations can happen. And that does happen. And most of the time, in terms of trade agreement, where there are interests of some big companies or in some sectors are taken care of. But for every small investment, it's not possible. So Indian investment, one of the biggest challenges is that they are small. But Chinese investment is big, so that's how they can absorb it.
I think that's.
Sorry, someone wanted to say something.
Sorry. That's very interesting. That's very interesting about the size of the investments. But I think what's also quite important for the Chinese is the question we should be asking ourselves about the SOEs, the Chinese SOEs, are they really staunch profit maximizers, right? Are they going out strictly for economic profitability, or are there other motives for their investments? Okay, so this is actually quite important.
So you're saying you're suggesting that there's a political motivation which for SOEs especially because
Yes.
and that is an interesting point. But you know, one of the things that kind of geopolitical interests come into play here and creating influence and so forth, which every government, most governments in the world currently, you know, kind of the land grab equivalent of trying to get involved everywhere. But what is interesting is the absence of a coherent Indian government policy towards uh, outward FDI, especially outward FDI. You know, and I understand the signals from what I've read. The government wants to have a kind of a coherent policy towards Africa, but I don't know if there is such a thing happening or just talk. A friend of mine who is an investor was telling me that he'd approached the Exim Bank, Indian Exim Bank, and after 2 years of paperwork to and fro, uh, he's still not seen any money. And then when they finally did, they explained that it might take up to 5 years before he gets a straight answer, which of course is not indicating any government support. There is money officially for collaborative activity between India and Nigeria in this case, but nothing is possible. So, you know, Biswajit, IIFT is a organ of the state, if I'm not too mistaken. What do you know about the policy in India?
Yeah, IFT is an autonomous body. It's not an organ of the state.
Well, you
But
train all the bureaucrats. From what I know,
yeah,
all the bureaucrats have studied under you.
yeah, I have been seeing, you know, and studying India's African policy also, and part of many efforts the Indian government made in the past, as well as in the current regime as well. So, so India had a Forum Africa Summit as an effort to bring African countries together. And right now, even current Prime Minister is also having an effort through Voice of Global South, where IFT has been involved for capacity development, because what we understand, handling the bureaucrats in Africa, one of the most important thing is the skill gap in terms of ability to take decisions which are in favor of their country. So because trade capacity is a complex thing, and IFT has been involved. So I've been also traveling to many African countries, West Africa, Southern and East African countries. So one important aspect here could be that India's vision towards Africa need to change. So we have been seeing that China is having an effort like BRI, Belt and Road Initiative, where actually the state is omnipresent, right? So, so as a part of BRI deal, there are other aspects like, you know, some of the sectors might get opened up, and there are SOEs as well as private Chinese companies can come in. So India is not having any such policies. So it has ODA effort in different sectors, but you know, India historically wanted to invest in the socio-economic aspects in Africa. For example, large investment in health areas, in education. Even India has invested in developing supercomputer. So something like that. So the focus was always different. But I think, you know, from this discussion, one point is coming up, that how India can actually utilize Africa for its benefit as well as the global benefit. So one of the three major challenges what I foresee for India. There are three: insecurity. One is food insecurity, second may be mineral insecurity, and third is energy insecurity. For these, Africa is the solution. Right. So, so China understood these things much before. I think, you know, as Roger mentioned about there is much more bigger agenda of China having a say in African decision making. As you can understand, critical minerals and many other areas, China is a leading player in Africa. So they thought it, many years before. So I think for India right now needs to think about, for example, in case of food security, many African countries are having big agricultural land, not fully utilized, whereas in India, food inflation might go up. So Africa could be a good place where actually investment in agriculture can help India. Similarly, now India is investing in oil and gas, but in other minerals also an important area. And linked to it is definitely energy sector. Nigeria is an important player in this particular aspect. India also must develop the consumer durable space as well as the trading space. Can have a lot of joint ventures along with many companies, maybe South African companies or maybe companies from Nigeria, for developing the African market, because Africa's middle income class, their growth rate is possibly one of the highest in the world. So it will be the main space for middle class in coming days. So as India has having an advantage in this particular area, so India must take into account. So India's policy must hover around these areas. One, for their own security, Africa is needed, and second one is definitely for developing Africa's manufacturing sector. India can play a very important role.
Yeah, no, this is very good. I know that Ramesh, we are running out of time rapidly, but Ramesh, first, I know Ramesh has been holding himself back. Go for it.
Right. Thanks for that. In the end, business is a risk-adjusted return game, right? The perceived risk on Africa is a very high one. I think we should all understand that the Chinese are able to make these big bang investments here because the big aspect is that the Chinese government has de-risked sovereign risk, which is one of the largest risks all businesses face across Africa. Okay, that then gives them the freedom and the courage to come and invest and make all these big commitments in Africa. The Indian investor, on the other hand, has to fight this battle himself, take on the sovereign risk, take on a variety of 30 other risks before he can invest and hope to get a return. And while the returns in Africa are interesting, if you get it all right, execution is the biggest challenge. So therefore, I think the space in which the Chinese investment is working and the Indian investment is working are completely different from each other. And that also explains why the scale of the Indian investment is so small, because the courage to invest here with such large risks staring in their face is very weak. That's number one. Number two, in response to Dr. Biswajit, African food import is going to touch 110 billion by 2027. So the dream of making Africa a net food exporter is a long drawn one. I've been in the sector of growing food and managing food businesses for the last 30 years. So we are some distance away before we become fully self-sufficient and capable of exporting. Just for your information, South Korea is the single largest landowner in Africa after African governments. Not a single grain has grown there, simply because having land in Africa is the easiest thing in the world. Converting that into crop is an impossible challenge. I'm sorry if I'm sounding so pessimistic, but this is my experience.
No, I think this is really interesting as well. I think that we are coming to the point when I think I should ask each of you to have a few chance to. There are lots of comments in the chat function, and perhaps if you pick out what you think is the most interesting for you, you can answer some of these, but also add some kind of closing remarks. I know it's time for dinner in many countries, and I know that in much of Africa, people are now sitting down to dinner. People in India are going to bed. Biswajit, thank you for being so alert. So, but let's go around the table and have some comments here. Let's start with Terry.
Thank you. I would just reiterate that I think there's tremendous opportunity here for India if we can somehow in the documentation that we produce out of this webinar, I think the recommendations would be that India should look to develop a more coherent policy, and then also look to to the infrastructure and agencies within the government to provide de-risking opportunities for private sector and SOEs to come into the marketplace, because I think there are opportunities. I did agree, Ramesh, that Africa being an exporter of food commodities is a long time away, especially with the growth of the population over the coming years. But I do think that there's opportunities for India to explore in the mineral aspects as well as the agricultural aspects. I mean, Indian firms are already engaged in agriculture, so if they could just expand that work and take advantage of what's on the ground already across much of the continent in terms of Indian exposure. So I'll leave it at that, but I agree with the 3 insecurities that the doctor also mentioned that are highly advantageous for the Indian government to start to look at.
Thank you, Terry. And again, in no particular order, let's Roger.
Thank you. I think what I would like to really emphasize from an Indian perspective is they should try as much as possible to leverage diplomacy. I think Africa is very important when doing business in Africa. The relationship with host governments are really key, like in most developing countries, but Africa, very important. Like what Ramesh was talking about, Ramesh made a statement that most Indian investors, you are here on your own, right? You're left to fight you're left to fight on your own, or something like that, something along those lines. I think home government support is what the Chinese have really mastered and done a very good job in Africa in really supporting their investments. So diplomacy really matters, and India should ramp up the level of diplomatic engagement with the African continent, because this helps in reducing risks as well. Diplomacy has been used to reduce as like a risk reduction mechanism, and it helps to give confidence for investors, Indian investors in Africa. So diplomacy is very important.
Yes, this is true, and I agree with this point as well. I agree with everybody here, but I think seeing investment as kind of strategic. The word so when I teach a class on strategic issues, I will explain strategy is about long-term, long-term positioning. How do you want to position yourself in the long run? And I don't think the Indian state has really come to this point when they understand the need to think in 10 years' time, where do you want to be, and how do you get to that point? It's Ramesh.
Thank you, Raj. My view is that the Chinese have discovered something that the Indians are still not clear about, that Africa is 56 different countries, and every conversation with the government is a very different conversation. If the government of India picks up just 10 countries and has one-to-one with them and opens doors for the Indian public sector private sector to just invest in those 10 on the opportunities that are available there, that will already be a good start. Somewhere, I think the government of India is trying to talk to the African government. There's no African government. So I think if they clarify in their mind that they need to talk to 1, 2, 3, 4, 5 countries and open doors for the Indian private sector, life will change.
Yeah. Excellent. Biswajit, our co-sponsor of this event,
I think,
get the last word.
thank you very much. And I think, what went wrong is basically, you need to see it from a larger perspective. Because of India's excellence in IT and with the globalization, India's, as well as India's interest in the Western world, and there's a complementarity. As a result, India will become very close to many of the Western countries. Post 2000, what happened actually because of Lookist policies, India's interest with the Asian countries have grown up. So I think, maybe inadvertently, what happened, India's interest on Africa remained at the same level or could not cope up with the kind of interest and the aspiration of the Indian investors are actually happening. But now what we are seeing in some of the sectors, like in automobile, in pharmaceuticals, apart from oil and gas, and in textile also. So renewed interest, we are seeing it. So from that point of view, actually, so now the information is here. It's the matter of time that how actually India engages itself with different African countries. And I fully agree with Ramesh that, identify 10, 15 countries where actually India thinks there is a large market and actually can push our investment there.
Thank you. It was nicely put. I think we have come together very nicely. I know that sometimes when I start these webinars, people wonder where we are going to get to. But we do get somewhere in the end, and it seems that we are all of a single mind for coming from different angles. So this was great, and I think really lots of food for thought. There's several people who have commented here. I know. I apologize. Ananya has a fairly interesting commentary, which I would have loved to have brought in, and so on. But I think it's a beginning of a conversation, and we're expecting that, of course, this IIFT relationship will continue to the future, and we will deal with this issue again in more fine-grained detail. So thank you everybody for attending. Much appreciated. The video will be up on our web. We'll edit it and it'll be up on YouTube in about 3 or 4 days' time. And yes, it's a pleasure. And hopefully we see you next month, July the 3rd. We have most likely a webinar on female entrepreneurship in the agricultural sector in Africa. So please mark it down your diary. First Thursday of every month is our great plan for the webinar series. So thank you to my wonderful speakers, and thank you to the audience. And yeah, wonderful. Thank you so much.
The Dunning Africa Center. It's not a place, it's a continent-wide conversation. Join us as we ask the pressing questions facing African business today.